I've seen these charts for years and years and years, and but I didn't realize that we had hit from a public debt as a percent of GDP, that we had hit the peak we reached in World War II. In the 2000 timeframe, there was the thought, could we be heading in the tech and telecom bust? Could we be heading towards that level? But here we are. And, that was a crisis time, and the country really did pull together after that to get the debt as a percent of GDP down. It did it in two ways. More control over government spending. Of course, we weren't in the war anymore, so that was a big source. But also on the GDP side, rapid growth. Post-World War II, very rapid growth. Doge, we think, is an attempt to pull us out of a quagmire, it seems, in terms of government spending. It's what held the economy up, or real GDP up, along with high-end consumers during the last few years. But this is certainly excessive as we see it now in context. And you can even see in the 20s, in the 20s and 30s, we didn't get anywhere near this level.
We're drowning in debt, and for the first time since World War II, there's no clear way out. That's the warning from Ark Invest CEO Cathie Wood. The U.S. has now hit the same debt-to-GDP levels seen during World War II, but this time without a global war to justify it. Public debt is skyrocketing, and the gap between government spending and revenue keeps widening. Right now, the economy is being propped up by high-income consumers and the last remnants of COVID-era stimulus, but that support won't last. Oil prices are plunging, in part due to Trump reportedly reopening talks with Saudi officials, possibly even MBS, to bring them down. Inflation seems to be easing, but the official data doesn't tell the full story. According to Trueflation, prices have fallen sharply, an indicator not of health, but of cracks forming in the economy. While politicians push tax cuts and deregulation as solutions, the real danger may be the collapse they're quietly bracing for. Stick around until the end of the video, where Cathie Wood shares what could shape the next major market cycle. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
This deficit is structural, and I do believe that with Doge and with more rapid GDP growth, we could move back into the period like the 90s. That was the last time we saw a surplus. And it was under President Bill Clinton and Newt Gingrich, who was a powerhouse in Congress, and they worked together to get that done. We do not have as much of a bipartisan situation right now, so we'll probably have to do more on the rapid GDP growth side of things. And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say. Onto monetary policy. Here, I've presented this a number of times. It does seem like CPI, which is in the green there, is kind of stuck in that 2 to 3% range. Now, there are other measures of inflation out there that are saying something different. There's a measure called Trueflation, and we'll have it for you in the next, I think we're going to subscribe to their service, so we'll have it for you in the next package, or in the next In the Know. It is saying that inflation is down to 1.3%. And this is a real-time measure of, I don't know, I used to say millions of products and services, but I think it's more like tens of thousands or thousands, but real-time, constant monitoring. And it peaked at 11% just about the time that the CPI peaked around 9%. It is now down to 1.35%. And as you may also notice, the oil price seems to be under severe pressure because Saudi Arabia is opening the floodgates. Purportedly, it is railing against Kazakhstan and Iraq overproducing, and is just opening the spigot. There could be other reasons. Part of the negotiating out there, President Trump, I think, is with Saudi ministers this weekend, maybe even MBS himself. And there may be, and as he's been very vocal about getting oil prices down. So that may be part of what's going on here as well. Of course, the third variable is weakness in the economy. So all of those accumulating, which is going to take that Trueflation measure of inflation down even further.
America's debt to GDP ratio has just reached World War II levels, but this time, there's no post-war boom waiting on the other side. In the 1990s, strong economic growth and bipartisan cooperation led to budget surpluses. Today, we face political gridlock, high-stakes gambles, and a fragile hope that tax cuts alone can turn things around. Inflation data is inconsistent. Oil prices are collapsing. Taxpayers are stretched thin, and commodity prices have dropped back to early 2000s levels. Gold is holding its value, gaining strength, while Bitcoin struggles to keep up. Treasury yields have fallen below 4%, sustained in part by over $250 billion in stablecoins. Saudi Arabia's oil strategy is rippling through global energy markets, and the 40-year downtrend in yields has now officially broken. According to Cathie Wood, we're entering uncharted territory, where tech-driven deflation could rewrite everything we thought we knew about the economy. No one has a clear roadmap for what's next, but Wood believes a major shift is already underway, and it's only going to accelerate in the years ahead. Let's return to her video as she continues to share her expert insights and bold predictions.
Now we're on to more market indicators. So Bloomberg's Commodity Price Index, we did this chart earlier this week. I think the Bloomberg Commodity Index has dropped back to 100, and probably will continue to go down if our economy is as weak as we think it is. But as I always like to highlight, the Bloomberg Commodity Price Index is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us. Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold is going up. Gold can purchase more in the way of metals at a given price. Now, this chart doesn't show what has happened today. The 10-year Treasury bond yield did drop below 4%. If we're right on what's going on here, the 10-year Treasury bond yield probably will continue to come down. I know a lot of people speak about China and other countries disgorging our treasury securities. And from a supply-demand point of view, that is happening, and it is a lack of demand relative to supply showing up. But there is a bit of a flight to safety going on right now. And there's also another phenomenon. I don't know how much it would have an impact on this, but the stablecoin movement, those are backed by treasury securities. And while they're treasury bills, I'm sure there are ripple effects throughout the yield curve. So the stablecoins are now up to 250 billion, and we expect them to go to 1.4 trillion in the next 5 years. So we would expect the pressure on interest rates in the near term here, certainly because of the economy, to be down, to go down. Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold. And as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gove of GovCal is monitoring, and he would not be surprised to see the S&P fall as it did in the 70s relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead, and the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield. We did break the downtrend, and that was a 40-year downtrend. Probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5. But clearly the burden of proof is on us on that one.
Periods of financial uncertainty often give rise to the boldest innovations. Back in 2008, fear and shrinking budgets paved the way for ideas that transformed entire industries. For more Daily Dose Crypto News, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.